Hey, what's going on, guys? Today we're going to be talking about the top 10 differences between individual stocks and buying ETFs and which would be better for you. Okay, so let's jump right in and take a look at it. So I've made this table here and I'll leave a link in the description below. You don't have to give me your email address or nothing like that. Fully downloadable, and we'll take a look. The difference between an individual stock and an ETF is, of course, the individual stock is the one particular company. The ETF is, you can consider it like a basket of different companies. Okay, so it's like a grouping of different stocks. Okay, just there's some other differences, but just so you know, so just so you can wrap your mind around it, it's just a group of stocks. Okay, so let's jump through the differences real quick to see what's best for you. All right, so I've put this document together for you to have a quick reference guide. These aren't in any particular order, but the last one is a doozy. So stick around to the end for one of the major differences. So the first thing we need to talk about is diversification. Investing in a single company stock concentrates your investment in that specific company, leading to higher exposure. The ETFs provide more diversification by holding a basket of stocks, right? Basket of securities, which can include various stocks, bonds, or commodities, thereby spreading risk across multiple assets, right? So when you're buying the individual stock, right, you have the one company, right? And depending on if that one company does good or bad, that's how much appreciation, if it goes up, or goes down. That's just on that one stock. But the basket, the ETF, so the ETF is diversified. So you have all the different stocks. If one particular one goes up or one particular one goes down, it's more balanced out. Okay, so that there's not that many big swings up and down as if you would to have. So potentially there wouldn't be big swings up and down compared to owning a single stock, which leads us to the next factor, which is risk, right? Risk is very important to us. Individual stocks carry higher risk due to the dependence on the performance of a single company. Poor performance or adverse events affect the company can significantly impact your investment, just what we talked about. ETFs generally have lower risk because they encompass a range of assets, mitigating the impact of a single asset's performance. So diversification causes potentially less risk in the ETF. So if you're not staying on top of things, particularly if you buy single stocks, you got to watch it. You got to watch it from time to time and make sure it doesn't turn out to be a dud, right? But on the ETF, what they do is they manage it, right? They're like, oh, this is a dud, get it out of here, like the S&P 500, right? Different companies come in and out of it, so they manage it by themselves so that you don't have to worry about, oh, I need to buy this, I need to sell this, I need to buy this. All that stuff's taken care of with an ETF, okay? So risk could be less in an ETF. And that leads us to the control over the investments, okay? Investors have complete control. If you like control, right? Investors have complete control over selection and management, allowing them to choose specific companies based on personal research and preferences. ETFs are managed by fund managers who decide the composition of the fund, resulting in less direct control over the individual holdings. Kind of like what we just said, right? You have complete control of which stock you want. If you want to buy Microsoft, you can buy Microsoft individually. But if you want to buy this ETF that's, for example, the QQQs, right, which has the top technology stocks, right? And if by some chance that, one of the stocks you wanted, Microsoft, it's in there, but if they decided to kick it out, you have no control of that. The cost structure, okay, so here's a big one. The cost structure. Purchasing individual stocks may involve brokerage commissions, but there are no ongoing management fees, but often come with management fees. Okay, so ETFs may or may not have higher transaction fees compared to individual stocks, but often come with management fees. What that means is that you're paying a management company, right? You're paying the fund manager a small percentage to manage all those stocks that are in that basket, right? That are in that bucket of stocks. So for example, SPY has very minimal, it's like 0.09 percentage. Make sure you look, when you buy a ETF, make sure you look at the management fees. And we always look at the management fees when we look at ETFs. So make sure you subscribe to my channel so that every time we look at an ETF, you'll see what the management fee is. Obviously, you can look at it yourself, but we go in depth on here. So make sure you look at the management fee when you're looking at comparing ETFs. The management fee swings quite a bit depending on which ETF you go. Exchange traded funds is ETF, in case we didn't talk about that earlier. Management style, okay, requires active management by you, including ongoing research and monitoring each company performance, right? ETFs are usually passively managed, tracking the specific index, which can benefit investors that like a more hands-off approach. So like we said, kind of like what we alluded to before, you're going to have to keep on top of individual stocks, right? In case they're, go wonky or whatever. And you're going to have to keep up with the research on, your company's performance, whether it's doing good. You're going to have to keep up on whether they're prepared for the future, what happened to them, if they lost if they, missed earnings or whatever. That's on you to do. But on the ETFs, you typically don't have to worry about that, since that's the job of the fund manager, right? That's what you're paying him to do with that management fee that we spoke about earlier, right? Liquidity varies based on specific stock. Blue chip stocks tend to be more liquid than mid cap or small cap. Liquidity depends on the index and portfolio composition. Some ETFs may be less liquid and highly traded individual stocks. So liquidity this right here is probably a less of a factor than most because some stocks can be liquid, some stocks cannot be, tax efficiency, it's a big one. Selling individual stocks can result in capital gains depending on the holding period and applicable tax laws. On ETFs, they often have tax advantages due to their structure, which can minimize capital gains distribution. So, but you got to be careful. There's a lot of different types of tax structures. So sometimes ETFs could be better for your taxes. But if you hold individual stocks in a tax favorable account, such as a retirement account, such as IRA, such as 401k. Dividend payments, investors receive dividends directly from the company, but the ETFs distribute dividends to investors based on the dividends received from the underlying assets. That's not such a big deal. What that's saying is you get, on individual stocks, you get the dividends straight from the company, but on the ETF, they get, the broker gets the dividend and then pass it along to you. Okay, but not a big deal. You still get the dividend. Investment accessibility. Investors need to select and purchase each stock individually, which requires substantial research and decision making. Okay. ETFs provide exposure to a broad market segment or sector through single investment, simplifying the process. So basically what that means is that you buy, if you want to buy, if you're buying individual stocks, you got to buy one, then buy the other one, then buy the other one, then buy the other one. If you're buying the ETF, you just buy it once and you get all of them together. You don't have to go individually and buy all of those, right? So let's talk about the big one here, performance potential, all right? That's the big one, right? Which one will perform better for you? That depends, of course. Individual stocks have the potential for higher returns if a chosen company performs exceptionally well, but also comes with higher risk. But also the individual stocks have the potential for lower returns if the company performs exceptionally not well. Okay, so that's why it comes with higher risk. ETFs aim to replicate the performance of an index or sector, offering more stable returns that mirror the broader market or segment. Kind of like what we talked about before, right? If you have the potential, if you pick a banger, right? If you pick a winner, right? That stock can go high and you're like, yeah, man, and look at that ETF. It's just, gradually going higher. But if you look at the flip side of the coin, right? That one stock that you get can go down so far, really bad. Look at, stocks that you've seen before, PayPal, Cisco, Juniper, whatever, the big dogs, Enron, right? You buy these stocks like, too big to fail, right? IBM, right? They just crash and you're like, oh man, I should have bought the ETF. But, the ETF could be considered safer, but it doesn't have the potential to skyrocket like an individual stock. So if you're really aggressive, if you're an aggressive type personality and you are comfortable with picking individual stocks, then, individual stocks, I do both, right? I have a combination of stuff, right? And, I keep some long term, I keep some short term, I keep some ETFs long term. Most of the long term. I don't trade in and out of ETFs, but I do a little bit of trading on the individual stocks, but typically I'm a buy and hold guy. But if you're trading in and out, then I would suggest you click on the link in my description. There's a course that you can join that has some info about, hey, when to sell, when to buy, that kind of thing. But you might want to check that out. Look in the description below. Full disclosure, I don't join that course, but I looked up on the internet and I found it. I was like, hey, this might be helpful to the guys, right? So whatever, get it, don't get it, doesn't matter. But let me know what you guys think. Make sure you like this video if you're interested in this topic, and subscribe to the channel if you like these kind of videos. Hit that bell notification to get all, and make sure you click all notifications to get all these videos. All right, and as always, thanks so much for watching. Really appreciate y'all, and I wish you much success in your finances and in life. Peace.